You're welcome to another edition of Islamic Finance Weekly, where we bring you developments in the non-interest market space as it affects Nigeria. In this episode, we'll be looking at the nexus between non-interest finance and the Commodities Exchange with the CEO of AFEX, Mr. Ayodeji Balogun. The AFEX CEO speaks on the commodities market trading in Nigeria and what can be done to improve the value chain.
Commodities are actually a very large part of our asset class as a country. So over 32% of our economy is actually tied around commodity when you combine both agricultural commodities as well as metals and minerals. So we are a commodities-rich country. The question is why, as an investment class, does it still represent a very small part of the pie? And that's partly due to issues around securitization and issues around the fact that the AFEX as the only active commodities exchange in the country has started in the last 5 years, and we've done a lot of work to ensure that we can actually unlock and securitize those transactions. And we're at a point of inflection where we're actually scaling that market very significantly, creating new products that are investment grade, and will be able to attract funding from both institutional and private investors.
He also gave insight into boosting the market liquidity and de-risking commodity trading.
Looking at the risk around commodity trading. So first, fundamentally, most, the tradable assets has physical grains that are very fungible, very highly, very well preserved in terms of the great integrity of the underlying assets, but also very high price determination. So it's very easy to determine what the price and the true price of a commodity is, and it actually reflects and has a natural reset every year. So if you look at the characteristics of commodities, they actually have lower risk as compared with a lot of other asset classes, because you have the physical grain itself that you can actually convert to cash at any point in time. Yes, you would have price volatility, endemic in commodities as an asset class. But then if you look at geographies like Nigeria, where we're pretty much rain fed for the agricultural sector. Producers produce around the same time, they sell around the same time, supply is excess around the same time, with prices then go down, and then over the course of the season, then the prices go higher because of scarcity of lower supply volumes in the market. So it's actually fairly predictable in terms of the direction. And as we progress and build the market, and we also create derivatives products, it will even be easier to hedge some of this price volatility and have even a more secure, sterile asset class.
Mr. Balogun also shared his perspective on how non-interest banking can play a key role in the commodities market in 2020.
So non-interest banking is one that fundamentally aligns with a lot of principles around commodities trade. If you look at the major tenets and the core pillars of non-interest banking, they're very easy to get it amenable to commodities. So fundamentally, one of the core principles of non-Islamic banking is that you have to have a product, a physical product that you are trading against. And that's where commodities tick one of the major boxes. You also have different structures where you could be able to ride on price appreciation without necessarily holding the commodities itself. And I think we've had a lot of discussions with non-interest banks in the country on how they could actually provide additional liquidity for the grains side of trade, but also provide liquidity for farmers that are interested in getting non-interest loans to produce most of our products, even the fixed income products that are available on COMEX, are tied around coupon payments and are not tied around dates or interest-bearing instruments. So even our fixed income are potentially products that could be looked into by non-interest investors.
Finally, he explores the prospects of accommodating non-interest financing in the current commodities trading framework.
There are several ways to dimension a non-interest fund that will look at investing in agriculture. So first, you could explore the exchange-traded commodities, which works like an exchange traded fund and you have a basket of commodities, and then the fund can track that price. And that would, to the extent that the underlying assets are compliant to non-interest tenants, then they would also, the fund will be able to participate in that. You could also have the fund take physical positions in itself and buy the commodities and write the price. You could have products where you have like the cost plus, where you buy the commodities and you're selling it at a premium. Or you have the agency model where you actually appoint an agent that does the transactions for you, and then you have a share in it. So there are several ways to look at it and structure a non-interest product around commodities, and we have a team that understands this. We also have other external consultants that we can engage to help develop specific products like this for issuers or non-interest banks that are interested.
And that will be all for this edition on this program. You can send questions and comments to news@procnd.com and reporter@procnd.com. Also, you can engage us on our social media handles displaying on the screen. Always remember to stay safe. Many thanks for watching, and bye for now.